On Point with Craig's Investment Partners.
The information provided here is general in nature. It's not financial advice. It doesn't take into account your financial situation, objectives, goals, or risk tolerance. All investments are subject to risks and none are guaranteed. So before you make any investment decisions, we recommend you contact an investment advisor. For more information about our services in that regard, you can go to our website, which is craigsip.com. Welcome to On Point. I'm Mark Lister, Investment Director at Craig's Investment Partners, and I'll be talking about a range of topics, including economics, portfolio strategy, investor education, and anything else that's happening out there in financial markets. I often get asked what I think about gold as an investment. So let's talk about the most precious of all precious metals. Gold has been one of the best performing assets over these last 2 years. It's risen more than 40%, which means it's even outpaced the mighty S&P 500 index in the US. Gold has long been regarded as a safe haven asset, and it's traditionally favoured by people that are worried about the health of the global economy and the financial system. However, it's also proven to be a pretty useful diversifier, which does make it a candidate for inclusion in mainstream investment portfolios. For centuries, we've thought of gold as a store of wealth. It's held its own through economic cycles, through geopolitical stresses, and lots of other upheavals throughout history. It tends to attract attention during periods of uncertainty because that's when investors are looking for a hedge against traditional assets. And unlike paper currencies or fiat currencies, as they're called, which are government issued and not backed by anything, gold is a tangible asset that isn't tied to any one economy or any one particular government. And what that means is that policymakers don't control its supply, nor can they print more of it or erode its value. It also often shines during periods of higher inflation, such as the 1970s. That was a really difficult decade for investors. Shares, bonds, and real estate, none of those things could keep pace with rampant price increases. And investors went backwards, particularly in real terms and inflation adjusted terms. There weren't many things that did well over that period. Commodities did okay, farmland did okay. Gold also did very well. Prices surged 14-fold over that decade. That's not always the case. Gold was much more subdued in 2021 and 2022 when you had US inflation spike above 6% for the first time since 1990. That could have been because global shares were doing very well for at least part of that period. Certainly in 2021, global shares were roaring higher. And when investor sentiment towards other asset classes is high, when people are still very keen on equities or other asset classes, gold has less appeal. It tends to do better when people aren't so happy with some of the other options out there. Interest rates are also really important for gold, particularly real interest rates, which is the interest rate less the inflation rate. So higher real interest rates bad, lower real interest rates good. And that's because unlike shares, bonds, or property, gold doesn't pay you to own it. It doesn't give you any income. There's no dividend stream. There's no rental stream. So when interest rates are high, there's quite an opportunity cost to holding gold because you're missing out on those yields or those income streams you could get elsewhere. But as interest rates are low or falling, the opportunity cost of holding a non-yielding asset like gold reduces, and that makes it more appealing compared to how it was before. Currencies also matter a lot for gold. Weaker currencies tend to have a positive impact on the gold price. You know, if the New Zealand dollar is falling, then the New Zealand dollar gold price is probably rising. The US dollar is really important for gold because that is the benchmark currency for gold pricing. And it's probably these last couple of points I've made that explain its strong performance of late. You've got central banks that are cutting interest rates for the first time since the pandemic, and you've also got the US dollar that has slipped from the 20-year highs that it reached in late 2022. If we zoom out and take a longer term view, we'll find that gold has delivered an annual return of 6.4% over the last 30 years. That's in New Zealand dollar terms, but I did look at it in US dollar terms and the numbers weren't particularly different. So 6.4% over 30 years, that's ahead of local fixed income, which has done about 6.0%, but it's behind New Zealand shares and international shares, which have produced annual returns in that 8 to 9% range. However, gold has been much more volatile than all of those typical asset classes, and negative returns have come much more frequently. So, in terms of its overall return over the long term, it's been just ahead of fixed income, but not nearly as high as shares, either here or offshore, but it's been much more volatile, much more of a roller coaster. But here's the thing, if you take your typical 60-40 portfolio, 60% in shares, 40% in fixed income, and then you add a small allocation to gold, let's call it 5%, but maybe as high as 10%. I wouldn't ever go any higher than that, but 5%, certainly single digits, the results get really interesting because the return from that typical 60-40 portfolio with or without gold over that period is about 7.7, 7.8%. So it's kind of in between bonds and shares because you've got a mixture of both, obviously. And adding gold doesn't change those returns. In fact, they increase ever so slightly. But what happens is that volatility falls. And the weakest 12-month period for that theoretical 60-40 portfolio actually improves. It becomes a little less weak. And the reason for that is that gold has a tendency to move in the opposite direction to other assets. And that's why it can be quite a useful diversifier. And that's not always the case. Sometimes it is going in the same direction as shares and bonds and other assets, real estate and so forth. But during rough periods, that's when it really comes into its own. If you look at the 3 worst years in the last few decades for that typical portfolio, they've been 2022, that's when interest rates were going back up to more normal levels, 2008, around the time of the GFC, and 2002, which was in the wake of the dot-com crash in the US. So all of those 3 examples came during times of US recessions, and your typical portfolio would have fallen about 10% in each of those calendar years, give or take. And New Zealand shares, international shares, they were down in all of those examples, 2002, 2008, 2022. Bonds went okay. They provided a good stabilizer in those first 2 examples, 2002 and 2008. But in 2022, bonds were weaker as well. So it was a tough period for investors. But if you look at gold, then in contrast to some of those assets, it went sideways in 2002, so it held its own. In 2008, it rose 40% just in that calendar year. And it was up 7% in 2022, which wasn't too bad because not much else was up in 2022. So it can make sense at times as just another diversifier within a portfolio. And that's the way you need to think about gold. If you're considering it as an investment, my strong advice would be think of it as a component of a portfolio, a small component, rather than as a standalone investment. It's not a must-own, in my opinion. It doesn't provide any income, and it certainly isn't without risk. It can be more volatile than just about everything, more volatile than shares even. However, a small allocation can make sense, it can provide additional diversification, and it can reduce overall portfolio volatility without any negative impact on returns. So I like to think of gold as an insurance policy rather than as an investment. I'm happy to own a little bit, but I'm also hoping it doesn't perform particularly well, because if it does, that probably means the rest of my portfolio isn't.
For more insights, visit craigsip.com.